Good morning, everybody. This is Kirk Spano. It is Friday, July 2nd, 2 days to Independence Day, freedom. I will be writing my freedom letter and posting it. The title is Freedom from Fossil Fuels Faster, and it lays out why oil and coal are going to run into massive disruption, even more than we've seen over the next 4 or 5 years, from legislation that is instigated or brought about through all the huge weather events that we're seeing, the droughts, the fires. I was just out west in Las Vegas, and though it wasn't the hottest Las Vegas I've been there in June, it was still pretty hot. The dust and the wind and the just, I would say, almost overwhelming conditions with the atmosphere there. I think it wasn't normal. It wasn't as bad as I've seen it in Phoenix, but it was pretty bad. And we know that the drought there is really just overwhelming them. It's the worst on record that they have records for, going back a couple hundred years. And I think that the governments around the world are starting to cooperate. I think we just saw that with the tax rate that 130 nations signed on to. There is a diplomacy that has reemerged that we haven't seen for about 5 years. And ultimately, things like the Paris Agreement and financing of fossil fuels through the SWIFT system and a number of other legislations. I would imagine that there will be a carbon tax shortly. I don't think the United States is actually going to see carbon exchanges. And the reason being is that they don't really reduce carbon all that much. And you end up having hedge fund guys and private equity guys gaming those systems to get super rich. I've told you about the place that I stay in New Hampshire that was bought by the carbon credit trader from Europe. He bought basically half of the frontage on a pretty big lake. It's where we stay when we camp. But, and God bless them for preserving it. But I'm not so sure that it makes sense to get super rich on not really saving the climate. There are things that are very simple that we can do without creating mechanisms for people to game the system. That said, politicians are involved, and they tend to see where the money is and get their greedy little paws between piles of money. So if piles of money are moving, they can get rich too. So maybe they do carbon credits, and the politicians get rich from that. So I'll keep an eye on that. If it looks like carbon credits are coming to North America, we'll stick our greedy little paws in there, because why wouldn't we? If they're going to set up the system that stupid way, we might as well take advantage, and then I will trust you to do something good with your newfound extra wealth. Speaking of extra wealth, last week we talked about Fast Acquisition Corporation. I told you good things were coming from it. I tried to explain why. And what we saw is that this week there was a deal with Fast Acquisition to add more assets to it without adding any more debt. Enterprise value jumped about $2 billion with a stroke of a pen. And the reason why Tillman Fertitta would do that is because he sees the money that's coming into those corporations. So he wants to monetize Fertitta Entertainment, which again is the Golden Nugget, Landry's, Bubblegum Shrimp, Vic and Anthony's Steakhouse, Saltgrass. What else do we got there? Rainforest Cafe. There's just such a big list of things that they own. Claim jumpers, which you have out in the Southwest, that with all the revenge spending and all the new markets that are open because you had baby boomer businesses go under and they're never coming back, which explains why 2.5 million new small businesses have opened in the last year, is that there's huge gaps across the market now, in restaurants especially, but entertainment in general, because a lot of venues went under. So the survivors, just like in any consolidation, the survivors come out stronger because they get more market share and they have more pricing power, at least for a while. So Fast Acquisition jumped from about 12 and a quarter last Friday. What is it today? About 13.50. So I really think that you need to be selling puts on that one. Sell the 12.50 August puts, you'll get about 80 cents and have a starter position. And it's a stock that if you take a look at the other casino stocks, you'll see it's got a huge runway. The runway is probably, maybe we can do a chart at the end of the day for FST. Maybe Scott Henderson, who's on the call, will help us. But FST, I think, is probably, based on the fundamentals, can pretty easily go to 40 or 50 billion in market cap. Right now it's 8.6 or 8.2. So that's, 500-600% run before it gets fully valued. And, at that point, we can sell it. Now, the shape of how it gets there, anybody's guess. Usually there's a spike at the end, and that's a good time to sell. And we talked about all those spikes a few months ago that all happened, and then we got the retracements. And we're going to take a look at what could happen here in the next quarter or two. Next week, I will release my quarterly outlook and game plan with the new plug and play list, which will have several additions and subtractions. And if you've been riding along over at Fundamental Trends, you know that we have a new article, Shooter Swing Trading Notes. So that's going to help us with entries and exits, especially for people who want to get into a long-term position but don't know where to buy it. So you can use these signals to trade or to establish long-term positions, essentially buying the dips. So today, Scott Henderson is on the call. He's the new technical analyst I've brought on board. He's a connection from Forex Analytics, and we still don't have our templates down and our processes down. We're kind of learning as we go, but we wanted to talk about risk on, risk off. We're going to talk about inflation. We're going to take a look at the equity markets today. So Scott, say hello.
Well, good morning.
How are you doing?
The great introduction.
Yeah.
Well, let's jump right into the charts here. Let's start with HYG. Now, there's a collective, and I'm going to point three out. The HYG, yen, and the US dollar JPY pair are the three things that I watch the most for risk off. Now, right here, HYG to me is the third tier. We're actually in great shape right here. I've got to count up around 95.06 where I'll start putting on some shorts. Which is, basically here, I would say by the end of next week, no matter what, I think we would be there. Then the yen already has come off itself. You can flip to that next chart if you would, Kurt. And that came off from roughly a 125.84. That's the UJ. It's going to be the one that just says the yen, the XL, or FXY, excuse me. That one, we had a sell back at 87.50 on that. And, we expect that to push towards 68. Obviously, FXY is the first tier, so it's risk off. And then the US dollar JPY is the third piece of that puzzle. And, right here, we're holding up well. I mean, I would expect us to back test that resistance line, that blue line that we have there, and then come off a little bit there. So we've been in this sort of descending wedge that's right there. And so I would say that if we flip up and look at equities, it'll sort of correspond with that.
Okay, well, let me ask you a couple of questions here.
Shoot, go ahead.
Back to the high yield bond. So high yield bonds often get ahead of the equity markets, and it's because people chase the yield. So as people chase the yield, they push the price of the high yield bonds up, and then you get a spread between high yield bonds and high quality bonds that are narrower. So your junk bond will have an interest rate that falls to be relatively close to your investment grade bond. And usually when that happens, you see an adverse impact to the market at some point. So how close are we to having a spread that just doesn't make any sense for being risk on anymore?
That's a great question.
The other way to ask that, instead of asking it from the interest rate angle, is from the price of the high yield bonds, how close are we to the danger zone?
Well, based on price, and the spreads are not something that I particularly track. I'm more or less following the counts, and when we have extreme overbought or oversold conditions. Now, you'll notice the channel that we have there. And one thing the app tells me is where our when we tend to get above those channels, if I threw other indicators up on this chart, it would reflect that, obviously HYG is overbought here. And, the spread honestly, I don't know exactly what point it would come in, but what I can tell you is based on price, I would say that we're going to have some level of risk off within the next 3 weeks. Now, I don't think it's going to be a crash per se. I would say we're probably looking at a 3 to 7% correction in some of the equities because we've been experiencing rotation. So, like, for example, I think we're going to have a little bit more of a pull-off in the Dow and a little more pull-off in the S&P versus the Qs or IWM, even though IWM is sort of led when we have some type of risk-off scenario. But there's a number of tells that I follow in the marketplace, which, they're saying we're past the breaking point now because they're using, 20, 40, or 100-year cycles, and a lot of those cycles are coming due as well. Now, matter of fact, that's highlighted on one of the charts that I provided to you. But, as far as the spread, I don't know exactly what level would be, hey, the catastrophe's coming. What I'm looking at more in that level is the M2 money supply. Right now I think we're at about $18 trillion in the M2 money supply. So it gets really serious if you go back and compare that to the Great Depression. The level that I'm looking for, extreme risk off where the world's ending kind of thing, we would need to be up closer to $115 trillion. So on the bigger picture, longer time frame, I think that's a ways off. I think we can continue to print for an extended period of time here. And I think the Fed has been given the tools to do that outside of their mandate, that you've discussed in other videos. So I think, the main thing with high yield is it implies the commercials are taking risk off, not necessarily retail. And I look at two different boxes because commercials really drive euphoric pricing. So if we look at the Qs and how we've had this run up, that's been substantially because the commercials have been buying. And if you look at the CPI in how they've been buying, you can actually see where they come in and out of the market. And I don't follow that on a daily basis, but I do look at it once a week, to get an idea what they're buying and what they're selling. Because typically when the commercials come into the market, it's constantly a selling relationship, like looking at copper or lumber, for example. It's solely based on the supply and demand metrics. And, the other thing that we can look at is the VIX. But honestly, I think the VIX is more skewed than what I'm looking at.
We'll get there. We'll get there. We bought the Fallen Angel Fund in high yield way back when these crashes were going on. And we probably didn't catch the bottom. We probably caught it about here.
Right.
And then it ran up to here. But I just want people to take a look at the historical nature here. So if we go back to different crashes, this doesn't quite go back to the Great Recession, but you can see that it's down here. And then we get that reflation for many years in high yields. And then we have the sideways equity market for a couple of years here, 2015, 16, where high yields come off. And this is essentially a reset of the spreads on interest rates between junk and between investment grade. Then you get the rally again as people chase yield and feel like there's not a lot of risk. But if you look across, this level here has been very, where your dashed yellow line is, very difficult to get much through. And that's even with a lot of QE starting again in September of 2019. And remember, September 2019 is when the Fed started bailing out the repo market, which again is a little bit stressed out. We get the pandemic crash, which I think starts to establish a limit on how far down things can go. Now, without Fed intervention, this trend line, I think, is pretty achievable. And this would, on the super long cycle chart, indicate getting way down here. Now, all the folks that talk about 70, 80, 90% crashes, in a vacuum, without Federal Reserve, without the Bank of Japan, Bank of China, and the ECB, you probably could see those things happen, right? But we're in a world where since 1981, we have changed how the monetary system works. And the monetary system continues to evolve, including cryptocurrencies. And you're going to start to see a lot of things reprice to new levels. So we'll talk about inflation in a minute, and I'm going to make the suggestion that inflation is temporary, but the higher price level is permanent. What does that mean? It means that the rate of change will slow down in the future, but you're not going to see your bananas go back to a nickel, right? So we're in new ranges, I guess would be what I would suggest. So with junk bonds here and the spread between investment grade and junk being very narrow, extremely narrow, a correction down to these lines makes sense, right? And then what Scott would do is measure momentum, and he'd adjust his targets to whatever's going on at the time. In an Armageddon scenario, somewhere in here, following this line, is where I think we would get. Would we get all the way down here? My God, I doubt it. But like I said,
I hope to God we don't.
yeah, but absent of central banks, it could happen. So let's live in reality land where central banks continue to do central bank things. And you start to see that you had a low here, then we had a lower low on the pandemic. It doesn't make sense that the next financial crisis is lower low than the pandemic. I guess on one level you could argue that yes, it would be if you're just going to think in technical terms. But I would throw out there that the central banks have no intention of allowing that to happen because they need, in this fight between organic economic deflation and inflationary policy, they need those higher price levels to create the devaluation of the debt that allows all these countries to function. So if you own HYG right now or the Fallen Angel Fund, what we're saying is that you need to really cut that back dramatically because you're potentially looking at, from 90-ish to 70-ish, a pretty big drop in a bond portfolio or a bond sleeve. And this is why I own gold miners. Gold miners have similar risks, but for different reasons. And the correlations of high yield debt to the stock market versus the correlation of gold miners to the stock market, the high yield bonds actually have a higher correlation, much higher, about triple. So you can get a similar investment with high yield bonds as you do with gold miners, but the gold miners have a lower correlation to the stock market. And what that means is you're more diversified. So I know a lot of people rode this, and probably some of you still own it. The reason why you want gold miners instead of junk bonds is A, the junk bonds are overvalued, and B, in a correction scenario, even though both things might drop, by not having the same correlations to the stock market, which is the majority of your portfolio, maybe you get some protection. So I prefer GDX, junk bonds right now. They were both pretty good down here, right? Because they get the rally. And they might both go down on a correction. But if they both go down on a correction, it's for different reasons. And there's a possibility that the reasons for the correction, whenever that might be or however that might form, could also, if we have an inflationary correction, right? If we get slow growth but with inflation, stagflation, then gold would do really well. Now, I have proffered a long time ago that we were setting up for stagflation. I think the pandemic changed that because we have all the revenge spending going on. And now we are about to get a bunch of spending bills and tax bills, and in my head makes sense. So what's going to happen here? I think that you have limited upside on junk bonds with, 20, 30% downside. I think GDX is probably similar downside, but the upside, if there's inflation, is way up. And why would there be inflation? The central banks do central bank things. That makes sense? I hope so. So let's take a look at the yen. And historically, the yen has been an indicator of people's risk appetite, especially institutional risk appetite. So Scott, what is the yen telling you with regard to institutional risk appetite right now? Is it pretty steady? Or
Well,
is
the
it
UJ, which is the dollar JPY pair, and the yen really are two different things in the correlations. The UJ, for really going into the boom well before the crisis, really from 2018 to really 2020, the UJ basically was an indicator or correlation to equities. And you literally could trade off of whether or not the UJ was up or down on equities as far as risk on or risk off. Now that started to wane substantially in the first quarter of 2020, and really we stopped using that as a lead to trade off of. But what the yen says right now is that, we're getting to an oversold level around where we are. We'll probably back test that resistance line, the blue line, and put in a back test of the lower range around 80, back around where that 3 is. Now the longer term trend, which we really haven't seen there, is that the yen is looking at a negative correlation. Now let me just talk about the negative correlations on my charts real quick for a second, because the application that I'm using is predictive in nature. For example, when oil came off and hit a negative cap, I actually had the count, and I wasn't trading it from that perspective. I was trading it off of a 3-drive top. And, we caught a piece of the short, but we missed the big run because at the time I was fairly new to the app and I didn't believe that it could occur. Now trading with the app for, just shy of 2 years now, I've sort of married it because it's more accurate than I am. And very often is it completely wrong. What we'll see is sort of a morph of one count in the wave counts. Like for example, here, if we came down and put in a higher 3 versus the count, the system itself would readjust, and it readjusts very much similar to real time. So if I want to look at a 15-minute chart or a 30-minute chart, I'm going to see a different step down motion. And, just like if you're looking at the UJ chart now, it's coming down like a staircase. And then you'll see certain points where you get that escalator down. And I'm really a counter trend trader, so I'm looking for those escalators. But at the same time, that protects fundamental traders like yourself. So I can say, hey, this is looking to me like we're going to come off, but I don't know how deep it's going to be. And really, that's what the yen itself, which is the onshore currency itself, and the US dollar JPY is the pair that's traded between the dollar and the yen. And that in correlation with HGY is sort of my risk off category. So we have the first leg, the yen was coming off when we took a peek at that chart real quick for a minute. The UJ has not come off yet. So I would expect it to bounce off that resistance zone, maybe overshoot it a little bit like it did on the 5.
So go to about here then, is what you're saying.
Yep. And then, then we're going to head down towards a lower number. Now, that could be very quick. When the yen comes off, if you slide back to the bigger picture of the chart, if you look at where the crises were, we have 90 or 87. If you look at how that risk off came there, and if, that was pretty aggressive. And if you look at 2008, now it was a slow, generous decline there, as I call it. In other words, it gave you time to get in and you had plenty of times to continue to re-enter because you had really sort of slow and lethargic back tests, so you had that stair-step motion down. The difference between an escalator down and a stair-step down is very easy to trade. An escalator down is why everybody tells everybody not to catch a falling knife, because they're very difficult to trade. I can trade those. It's not necessarily that I suggest that anybody else does, and sometimes I'm successful at trading those, and other times I'm not. But I like the more consistent trades, like we have the 2 that the UJ put in. I've been short since there. And I will continue to stay short and add positions as the trade continues to work.
So one of the things that I have told people over and over again, and people hear me say it over again, that the modern financial age, or the world, changed essentially in 1981 when Ronald Reagan came into office and we decided that we were just going to start deficit spending. Every president since then has deficit spent, and except for Clinton, it has been increasing deficit spending. So the curve on our deficit spending has been exponential. So when I tell people that the world changed in about 1981, then you see this, that's the new era. So this is the adjustment. And I want people to really conceptualize and put any politics aside is in 1981, we decided to enter the central bank era. That is when Paul Volcker raised interest rates real high to kill inflation. That's when the slow march that became a sprint a decade ago to energy independence began. And that's when the skim of the big financial system really, went from, a little bit of insider trading to systematic theft, as far as I'm concerned, with high frequency trading, algorithmic trading, the tax code favoring traders and capital gains investors versus people who get a paycheck. So the whole financial system in the country changed in 1981. And everything that we've seen since then is a manifestation of that. This lower range on dollar yen is part of that. Now, one of the things that I would suggest is that at some point, the dollar is going to be much, much stronger. And the reason for that is we are getting to a more mature age in economics, whereby new ways of handling the economy are emerging. We're switching from fossil fuels to clean energy. That is one of the things that Shamith has talked about as being his biggest idea, that the change from fossil fuels to clean energy is the biggest thing changing in the world. We are going from dumb devices to smart devices rapidly. We are going from computing power that we thought was a big deal. The computers that sent us to the moon are now in our hand. Actually, our phones are more powerful than the computers that sent us to the moon. Consider that the Hubble telescope just went dead after whatever it is, 40 years. And we have the ability to replace it. Granted, we can't get something that far out in space that fast, but we can replace that like easy. We're talking about putting cell phone towers in space. We have geosatellite systems, low Earth orbit satellites now. They can keep track of logistics, transportation, the climate, our enemies, our friends, the flow of rivers, anything that you can imagine that can be seen from space. We can now see it, quantify the data, distribute it, and find solutions to whatever we're finding solutions from. So the world is changing really fast, and it's not on a straight line, it's exponential. So in an exponential age, we have to consider not just these short little movements here, but when is it going to come back up here? And I think that a lot of people, especially your fiat money chanters, would say that I'm crazy. But when the crypto dollar comes to the market, you're going to see the United States get very strong. And I think it's all towards 2040, 10 to 20 years off for sure. But at some point, we have to be very aware of what happens to equities in our portfolio when the dollar finally wakes up. And the dollar is going to wake up. Now, we might get a small awakening before we get the big awakening. We might get 3 or 5 small awakenings before we get the big awakening. But it's something in the big picture over the next couple decades that I'm going to use to turn 7 figures into 8 figures and maybe 9 figures. So one of the hardest things that I have in talking to you is changing the ways that you think about investing. And I know that people want to do the swing trades, and we're offering them. That's why I brought on Scott. But ultimately, the biggest money, if you remember Paul Tudor Jones, probably the greatest trader in the world. If he's not the greatest, he's on the Mount Rushmore of superstar traders. He said, "Look, I miss a lot of the meat in the middle, but I've become a billionaire trading the edges and the pivots." So by using this analysis that Scott has, we can try to find some of these pivots, both that are shorter term in duration nature, but we're also going to keep our eye out for the big shift, because in the next 10 to 20 years, we're going to get several of them, and they're going to be millionaire maker events. In case you're not aware of what Scott is using, he is using a form of Elliott wave theory that is augmented by a software that has some AI built into it. So one of the core reasons I brought Scott on is he comes with a great referral from Dale Pinkert, who I'm working on getting an interview with. But he uses an Elliott wave theory that people just can't do by hand anymore. So using the AI to keep track of things and give ideas, I think gives us a pretty unique edge. And I used Motive Wave years ago when I played around with Elliott Wave. And what Scott is doing with it is way beyond whatever I was trying to do. So, I'm not a huge believer in any particular technical analysis. The reason being is that I think technical analysis is just trying to uncover what's true fundamentally. And for some people who can't do the analysis that I do on the fundamental side, technical analysis is going to get them there faster. So by marrying the fundamental analysis with the technical analysis, we could try to see am I potentially making any big mistakes? And so far, we haven't had really a mistake in, a year and a half. Were we a little underinvested on the rebound? Sure. But in the last year and a half, if you take a look at the stocks that I told you to buy, talking about ARK, talking about the gold miners, we're talking about TAN, we really did have the right sorts of things. We may not have had enough of it, but we had the right sorts of things. So what's coming in the equity markets over the next few months, that's what we're going to talk about next, is I think, what you all want to know. And I guess my short answer is a continuation of the rotations, but we might get the one broader correction that offers you some opportunities. And one of the things that I would tell you is that as we get closer to the culmination of zombie hunting season, which will take years, we have to be careful not to invest in some of those spaces where there's just no secular growth story. Somebody asked me about the banks last week. Could this be a trade? My answer is who cares? If it's good for the banks, it's better for Apple, right? It just is. So we need to focus on our investment barbell more and more and more, because as this exponential world unfolds and we get our signals on things, we're going to have opportunities for a redo. Remember when you played baseball in the backyard and somebody said, well, I want to redo. He was safe. No, he was out. Let's redo it, right? We're going to get redos. And when we get our redos, we want to take advantage of that. We want to be able to use a combination of education and hindsight and foresight and these signals to get us into the right stuff. So again, I would urge you to unlearn some of the stupid things that you read in the press and from the pretend analysts, the fake analysts that are out there. I categorically guarantee you that 98% of the people on Seeking Alpha are not giving the depth of analysis that I'm giving. There's a half a dozen people. And over the next year or two, I'm going to just tell you something. I'm a competitive guy. I've decided to crush them all. I think that's funny, but that's what I'm going to do. I'm going to steal their customers. I'm going to give better advice, and I'm going to crush them because they offend me as a financial guy the same way that the brokers offended me 10, 15, 20 years ago. That's why I went to being a fiduciary fee-only advisor. So this tool that we're bringing you, I think is going to give us some pretty strong signals. And Scott tracking this for us is going to give us some warning signs. And it's also at some point, I don't know when, at some point, we're going to get a signal that the dollar is about to start getting firm. And when that pivot comes, there will be a temporary period where equities get their ass kicked, but your dollars will get stronger. And then near the next pivot point, you will have the ability to buy the perfect portfolio, which you'll never accomplish. But by trying to get to perfection, right? Who am I quoting here? By constantly trying for perfection, we'll reach excellence. And I think that we've been there for a while now. All right, so let's take a look at equities. This is the SPY chart that he has for me, for you, for us. Whoops, that was the SPY chart. I just wanted to make it a little bit bigger. There we go.
Now that's really a big picture chart, Kurt.
Yeah.
Now,
so what are you seeing here? And I think it's interesting that I said my ultimate target is right around 500 on SPY, and that's kind of where you're at.
Yeah, looking at late 2023, I would assume that we get there. So what we're seeing here, and this is what, my coach and mentor, Dale Pinkert, is really influenced my trading a lot, and, giving him a plug, honestly, he's the best 3-drive coach on the planet, which is why I went to him, because, I'm a believer in education.
Can you explain that? Explain that.
Okay.
You said 3-drive. Explain that to people.
Okay. Now, when pull the chart up just a little bit so we can see the RSI down at the bottom there. Now, when basically how a 3-drive works and where the number 1 is, the blue number 1, you'll go down to RSI down at the base of the chart, and you'll notice that we have a confirmed high there. Now that was back in January of 2018. If we flip over to the second blue tab up there, that's our second drive, and we have a unconfirmed high. And now if we look at equality, which is why I threw it up in the center of the chart, these particular patterns like to be equal. So when we put in a 3, right, we could put in a shallow 3 because often 3 drives morph into XABC patterns, which is a harmonic pattern within Elliott wave. But typically they're equal. So if we take our cycle waves, which is the blue line, in other words, I went back from the beginning of the entire wave down to 0 and 1, our count would come a little later in January 22. So we should have a corrective wave, basically at that point, and by the time you see the number 1 that's further out in the chart, is our entire cycle wave should complete by the end of January of 2025. So that would mean we're going to be in a bear market from wave 5. But a 3 drive basically is one confirmed high, a divergent high, a second divergent high, and then that pattern has the potential of retracing 100% of the move. And now these come few and far between when we look at chart patterns, but I pay a lot of attention when I see these because reality, and I joke about this, if I catch that 5 and I'm accurate, I could retire off of this trade because it will be that extensive once it occurs. And, so I look for that. But also I show this chart because we're really putting in a 3 here, which is an internal wave of that larger pattern. And again, going back to how wave counts work, they step up. And if you look at the corrective wave over back towards 2015, 2016, where we put in a 5, you'll notice the ABC correction down lower to the left there. That's how a corrective wave comes in. Sometimes they're euphoric, just like we are in parabolic curves up. But, that 3 is probably going to retrace down to about buy any dip at 382.46, which I'm expecting to come in very soon. That 434.92. I think in our room we put in 432 calls. I think it was Tuesday or Wednesday. And, it was just a quick scalp because we broke out above. There was some, question in the charts and price whether we'd roll over there. So I was waiting for the breakout before I took it. Anyone who's in those 432s, once we hit 434, I'd tighten my stop right up so you can hold your profits and get out. Or if you sold, obviously do the same thing on the other end of the spectrum. Right. But that's basically how a 3 drive works.
Right. So what I have told people is that in the next 3 or 4 years, we'll probably see around 500 on the SPY because we tend to gravitate around shiny numbers and the financial industry has the power to push things for short periods of time. Right here, I've said that from the low 400s, we'd get a pullback, and I've showed my charts with very similar trend lines that we get a pullback. And ultimately, I always thought that we'd get back to this range, right? And before it broke out, I actually thought that we'd retest potentially this 2015-16 market. Now, from a fundamental standpoint, the value of the S&P 500 should be between 2,000 and 3,000, depending on how you adjust for interest rates being low and future expectations of interest rates. So earnings don't come close to justifying current valuation. But as we know, for long periods of time, nobody pays attention to earnings until something kicks them in the junk and tells them pay attention to earnings, right? So there's an event or there's just not enough money to chase anymore. A number of the technical analysts that I follow have been saying that this area right here, and these are not even including people who aren't Elliott wave people, are saying that this peak in 2018, and then this peak in January this peak in January 2020, from here to here is an important zone, and that roughly coincides with your 1 and your 2. And depending on who it is, they draw their lines differently, right? They go sideways, they go like this, they level it off. But this line right here, this red line right here, which is about 340-ish, is that? On the SPY, seems to be one that a lot of your financial industry people are targeting. So a correction down into the 340s on SPY. Now do we get that far? Who knows?
Yeah, those support and resistance line on that particular chart is the 21-day.
Okay.
and just, they're really, moving averages is something that, and Dale speaks a lot of, and, he's a 50, 200 day, I've just had it ground into me. He would have a target of that 200 day on a retrace looking at this. But basically above the 8-day, which we are now, I'm long. Below the 8-day, I'm short. And those blue and like oblong colors that I have at the top end of the chart there reflect support and resistance based on the 8-day simple moving average. And then on those blue lines that come across where your mouse is right now is the 21-day simple moving average. And the blue line below it is support off of that 21-day moving average. So those are channels that you'll see price when we're above those. Technically I could go look at RSI and MACD and other things and determine that we're overbought. But the reality is when we get above those lines, we're overbought, in my view, and we get below them, we're oversold. So, those are also buy points, and you'll notice that they're consistent. If you look at the stair-step motion up, it's a very simple way to determine whether you're on the right side of the trade.
So the next move down, you'd anticipate to be somewhere between the 50-day and 200-day, or closer to the 50?
We could push all the way down there. I believe this is simply a retrace. Now, really, I classify corrective waves really in two groups: a retrace and a correction. Okay. Right now, at this point, I'm expecting a retrace, which would push us towards, now you'll notice the fib levels that are highlighted there. Right now, today, 40, 30, 23 was the 78.6 extension from wave 2. So if we take the first, or up towards where that blue 2 is, that little support and resistance line right there is about where the second leg of, if there's a chart tool that you use to set your fib extensions. Most people would be thinking the 78.6 is where I'm going to get short. However, my app that I'm using here, or the way I'm using it, is giving me a little more of a euphoric push. In reality, when we get a euphoric push, none of us know how high it's going to go, and the counts evolve. So we could push higher than that 434, but I don't believe so, because I think it's already oversold. And if you looked at the other SPY chart that I provided you, it shows you the different counts. But on the corrective side, the 78.6 on a retrace off of the 5.
All right, so this correction then, you're seeing buy the dips down around 382?
382, correct.
All right, and we're 420 right now. Is that what we're at? 428.
Yeah, it's decent retrace. Yeah, I mean it'll be a 4 that we put in there. Right. Now here you see the different counts broken down on that particular, on the first SPY chart. That's what I mean. See, my first target was 428.56, and when that did not manifest in a retrace, which you see the little leg to the right, the red Fibonacci retracement box, as I call it. And one simple thing about fib retracements used with Elliott Wave, what I've recognized over time is that between the 23.6 retracement and the 78.6, that box right there, on any retrace, we're there over 70% of the time. So counter trend, it's very easy to trade those once you learn that. So when we push past it and we break out above that, we know we're going to our next stair step up, which is where I came in with the 434.98. And now I'm looking for a correction there because we overshot the 428.56. But it's quick enough when you're looking at a chart where you can execute pretty quickly when it goes against you. I mean, none of us are right 100% of the time. I'm happy if I'm right 50% of the time, but most of the time I'm right more than that. And, to be honest with you, Motive Wave, the way that I've started to use it, it's more accurate than that. It's probably accurate 75% of the time for me. So I would look at trimming on the Qs as an example. It's not quite, it doesn't look quite as euphoric as the Dow for a corrective wave. It's sort of muted. But I think that has a lot to do with what we just went through the last 6 weeks, where we had that digestion zone that we went through, where we weren't sure if the Qs were going to roll over or not. And, out of all four of the indices, I like the Dow look the best. And the reason is it's most consistent with Elliott wave theory and a retrace. So, we can pretty much say we can sell off of this 5, which we're at now, and we've actually come off of a little. Notice the last monthly tick, we came off of the high from the 350-232. And I would expect a back test of that, and then we would retrace down towards the 50% level, 38.2 in that range. So I've got a buy in there about 312. And obviously I'll adjust that as I go through those. The monthly chart is a long time frame, so the reality is you really only need to look at those once every 2 weeks. But I'll have weekly charts posted in the swing trade section, as well as daily when it's necessary. So we'll step down from the longer term charts as our targets get closer. And sooner or later, when you start seeing me post a 4-hour or a 1-hour chart in the swing trade center, that means that the trade is in play, because I'm going to step down time wise. So we're looking at so what charts we need to focus on to trade. But looking at IWM, which is the small caps, we had one heck of a euphoric run here. I mean, that pull up from the 2 was historic. And the reality is it should continue. That 5, in looking, Elliott wave likes 3 counts. It likes 5 3-5s in patterns, or it likes 5 3-5 3-5s. And in this scenario, we've got a 5-3-5 and it's clean, even though the count doesn't tell me that 5 could put in a 300. Okay, the reality is when I look at this chart, it could. But right now, the way it's been reacting, it's sort of acted exactly like the way the Qs did in that digestion zone, which is right around where it put in that prior 5 and then the ABC right there. But we'll have tells in other indicators whether or not we're going to continue in another 5 or whether it ends here with a shallower 5, like right now the count is telling us. So those counts morph over time, and in shorter time frames, it stair steps down just like it does in the larger time frames. So whether I'm looking at a 3-minute, a 15-minute, a 1-hour, a 4-hour weekly chart, or a monthly chart, there are different wave counts in each of those legs in a stair step motion up and in a corrective wave down or a retrace down.
All right, so I have a question.
Go.
So in general, our theory of investing is pretty simple. The S&P 500 is full of zombie companies, so we stay away from the S&P in general as an investment. We would never buy SPY, but we use it as a gauge of the broad market. Dow Jones, that's only 30 companies, and they've rejiggered it now to be a little bit better index, in my opinion. So it's okay to watch, and I think that we could definitely trade the diamonds if we ever wanted to. But I think the big things are QQQ, because that's the huge secular trend companies. And then we're getting a major rebalance in the Russell 2000 right now. And I think it's pretty clear that there are some huge opportunities in there, but a lot of those stocks are, your Cathie Wood stocks, right? You have quite a few stocks that memed it up, and you're getting this consolidation in here, correct? Getting a consolidation for whatever reasons, whether it's why I said or whatever. So we're getting this consolidation in here. If it corrects here in the next quarter or two, so say by the end of the year, maybe if it's even next year because maybe tax policy doesn't do what we think it's going to do. But the next correction on the Russell 2000, right around here, seems to make a lot of sense to me. Above the trend, right? I don't see this breaking unless something horrible occurs. So we get a correction into here. That's a pretty major buying opportunity if that happens then, correct?
Yeah, that's major. Yeah, and I'm just noticing now I didn't put support and resistance on that particular chart, so I'll apologize for that. But in looking at, the corrective leg, the first thing that we would be able to do is go from the 5 and measure an ABC off of that, which would probably come down about 210.
Yeah.
I don't think we would go much below that 210 if we, and the only reason is because we've already had an extended consolidation period and a correction. If we look at the February of 2021, And, right in that period, and then we go back and look at the February of 2020. That's a pretty extensive correction for a product that is American driven. In other words, almost no one in IWM, any of the stocks there, have international exposure. So, that's a good barometer on the U.S. economy. So I think what we've also seen in price is that you've seen some inflation adjustment in the Russells, which is good. So that would mean if we have some continued inflation, the Russells should continue to inflate as well. I tend to be a little more bullish in the Russells, and this chart doesn't necessarily reflect the longer counts, but I would think the retrace in the Russells is much shallower than the Dow or the Qs because of their exposure to international yields. And also that 15% or that flat tax rate they're talking about with corporations. I really haven't gotten my arms around that yet to understand how that's going to affect the mega stocks. I think it is going to give it a little bit of a headwind, is my first response, and I do think it's going to be inflationary. But I tend to be a little more bullish the S&P right now and the Russells versus the Dow. The Dow, I'm going to say, will have the most decisive correction out of the four indices at this point. And the reality is the Qs could just stagger right where they are because the dollars come off and yields have come off as well. So, it might just chop around here for 2-3 months and not go anywhere, to be very candid. And if you look at the floor on the count there that I have just below where the 350, 342 count is as a good entry, the wave count is giving me a very shallow retrace off of that 3 up there, which is the sell at 370.71, which we haven't gotten to yet. So literally, once we get up to that the 370, we obviously are going to have a little retrace, but nothing significant there. I think it's just going to plateau and ultimately put in that 5 up around 381. I don't see any reason why it would be more aggressive than that unless we had some significant catalyst, like all of a sudden a huge inflationary drop. In the cost of commodities, as an example, would be what would give it a tailwind for me. Or all of a sudden, we get some beneficial tax treatment for, the FANGs, which right now I think I don't want to call it a hostile market, but it's definitely not planting a rose garden for sure.
Right. All right. So I'm going to start wrapping this up here, but if we get a correction here towards 300, I mean, that would, if it got that low, I mean, that would be pretty big time buying option. So unless it's on an elevator drop, right? Unless it's an elevator drop down, this area right here above these counts, right? Because it'd be pretty tough to get below here. You'd have another
it would negate the entire wave up if it got below wave 1, which wave 1's way back down at 2030. So it would negate the breakout if it broke below that.
Yeah, and I can't imagine
that is a serious correction. We get below 1. Right. It is unlikely it will go below the 3 on that, just a little bit lower from where your mouse is.
Right.
It's unlikely.
And my experience is that it probably doesn't go below here. So
I would agree.
300-ish, if we see that, and I think we're going to, now all of a sudden you have your opportunity to get back into Microsoft and Amazon and Google and QQQ, right? If you're dumb like me and sold it way back here. So, that's what we're looking for a re-entry, I think, is around 300-ish on QQQ. I think it would take something really bad to drive it further down than that. And there are people out there calling for that. But again, a lot of them are your Austrian economist types who have generally been wrong for 40 years. So take that for what it's worth. We're going to talk a little bit about inflation in an article this week, but I would just point out that this one, I asked them about lumber on here. Everybody was talking about lumber a little while ago because of that huge spike. Just look at how spikes work. Spike, crash, and now it's going to start to consolidate. But he really, Scott really looks at copper, and copper looks to maybe have reached a limit here recently. And so what are you seeing with copper? Are you seeing a consolidation with copper now?
Well, what we're really in is a corrective wave off of the initial push. So we could retrace back down to, 648 is probably a good line where that gold line is down in the center.
Yep.
The one thing, the RMB, which is the offshore Chinese yuan, if I can pronounce that correctly, forgive me. No Chinese heritage that I know of, but it right now the chart says we're going to 8. So if that manifests, and if you'll look at the inflation deflationary gauge here, that would mean that we should go back into a deflationary cycle shortly. And just if and this is just something that caught my attention, when I'm playing around with charts and looking at different things. I'm like, hey, there's a huge correlation between the offshore yuan and copper, obviously being one of the largest commodities on the planet, it's outside of coal. The correlations are very defined here. So when the RMB ramps, copper retraces. When the RMB retraces, copper ramps. And it's been very consistent with that. So I would think that we continue to retrace towards 648 maybe. And it may be shallow there even, because I still think there's some significant inflationary. The news China's so big when it comes down to copper.
Right.
We're hearing shortages there. If they actually if those stories are true, all China has to do is start buying again at any decent level, and that retrace could be just that they filled their storage bins and they don't have any place to put more copper, raw copper. But in tracking copper, those buys that China makes, they're substantial in trading that commodity. But I think the yuan continues higher from here. However, an alt count that I have off of that 5, which is up there really around its peak at 725, I think, or 722. There is an ABC correction off of that that's much deeper. In other words, it's a 333 instead of, right now we have a 3 there instead of, which typically in the wave counts, they come in patterns. So we have one alt count that could take us all the way down to 540 in the yuan. And if that happens in the yuan, copper could double from here. So, I mean, it's sort of, hey, if the yuan comes off and we continued lower, I would expect continuation of copper prices to go higher. But it should be fairly easy to monitor that, just using a regular weekly chart to do so.
So, to my way of thinking, this is maybe the most dangerous chart in the world, and here's why.
I agree.
China has major demographic problems. And again, I'm talking longer term here, not the next 3 months, but I'm talking over the next decade or two. And remember back a little over a year ago, I talked about how COVID was the perfect disease for China because it killed a lot of elderly people and sick people that they can't afford to take care of, and that we're slowing down their growth. Now, just coincidence that disease broke out there at that time, or an accident, or something worse? I don't know. I don't really care at this point. Maybe I'll write a novel about it just to make a couple bucks. However, China at some point is going to have massive problems with their demographics, and they're going to have to essentially print money or borrow a ton of it, or sell off all sorts of the currency reserves that they have, or some combination of all 3 of those things, most likely. Right now, you have a little bit of a correction in copper, and that probably is temporary, because when the yuan gets weaker, copper is going to have to go up. And we can see that chart, right? I mean, this is the perfect alligator jaws, right? Opening and closing. That's what this chart is. Somebody asks, what could be the catalyst for an elevator drop? And I think the scariest thing out there is that if China's economy falls out of bed, if China's economy really has a massive problem, an actual recession, that will crush the global economy. And I don't think we're there yet. However, at some point, yuan's going to get weaker, the dollar's going to get stronger, commodities are going to get goofed up, and equities are going to get crushed. I'm not sure how close that is, but it's going to happen someday.
I agree with you.
So, we have to keep an eye out for that. And between now and then, our job is to be on the right side of the secular trends, understand what central bank policy around the world is really doing and what U.S. government is trying to save, which is your jobs. And that's what they're trying to do. Because even if the stock market gets beat to hell for a couple of years, if people keep their jobs, they'll tolerate it. But if they lose their jobs and their retirement plans, you get the stupid populist reactions that we've been seeing for the last 13 years now, right? From Wall Street, Occupy Wall Street, to I'm going to call them what I call them in public and private, the Trump tards who stormed the Capitol, and everything in between. Your AOCs out there, your reactionaries, just all the reactionaries. At some point, we have to protect ourselves from reactionary movements because that is the one thing that could wreck society and put us into a spiral that we have a hard time coming out of. Hitler, right? It took a very long time to get to Hitler and then a long time for Germany to rebound from Hitler. And in between, there was a horrible war. The economy is important to protect, and it's important to make sure that you don't have 1 billion or 2 billion hungry, cold people somewhere in the world, whether they're here or in China or India or anywhere else. And I don't know that this horrible thing is going to happen because maybe the governments are smart enough and now they're talking to each other again to figure it out, because there are solutions and they're not that hard. But when you're reactionary and when you're extreme and when you're stupid and when you're greedy or corrupt or a megalomaniac, or you're willing to say things that aren't true because there's disaffected people who will grab onto it, probably knowing it's not true but not caring, we get bigger problems. Copper is one of those things that tells a story. And it tells a story in the context of currencies. And I've talked to you about the dollar and other currencies repeatedly. The thing that will protect our freedom in the long run is an inclusive, diplomatic, globalist approach that cracks down on the big skim from the 1%ers, is more inclusive to everybody in the country and the world, moves towards a cleaner environment, and a system that encourages capitalist recycling. What do I mean by that? It discourages hoarding. Hoarding is bad for everybody because only a few people get to hoard. Then everybody else is in trouble. Look at any dystopian movie. So if you want to protect your freedom, encourage inclusion across the board. Encourage tolerance, and it'll lead to good things. And if we head in the other direction, it'll lead to bad things. I don't know if good things or bad things happen in the future, but what I'll tell you is that for the last 80 years, good things have been happening. There's less people starving. There's more people in the global middle class. There's less disease. Even with the pandemic, we have less disease. Why? Because since polio, right? You remember when you had polio? Oh, you don't, because you had a vaccination. So as long as we keep doing the smart things that we've been doing post-World War II, things will continue to get better. There'll be fewer wars. We have less people dying in war right now than ever before. You may or may not know that because, hey, we just bombed somebody. But the reality is that every statistical subset shows that the world has been getting better since World War II, and it's been getting better faster in the last 20 years since 9/11. Can we break it? We certainly can, because we're people and we do dumb things. Could it continually get better? It could, and that's my guess as to what actually happens with some hiccups. So take it for what it's worth, and when you watch your fireworks this weekend, think about what really makes the world a good place. And what it is...
People like you and I, buddy.
Well, it's just be nice to people. Be nice to everybody, regardless of the color of their skin, who they sleep with, what they worship, where they work, whatever. And it works out.
It's
when
so
we stop
easy to be
being nice
kind
to each other, yeah, right. When we stop being nice to each other, we're in trouble. All right. In any case, thank you, Scott Henderson, a new analyst on the technical side. And
Appreciate the intro.
Yeah, and I will get this published probably today and on YouTube. Next week, we'll have the outlook for the quarter and really, I think, the rest of the year. And really this cycle, this presidential cycle, I think is interesting. I do think that we ultimately hit all the topside targets in the next 3 or 4 years. So you take that for what it's worth. All right, everybody, have a great weekend.
Thanks for joining us, everybody.
Yeah, have some corn on the cob for me.
Great. Oh, you're not going to cook any?
I'm starting to do the low carb thing again. We'll see.
Oh, goodness gracious.
Maybe I'll start the low carbs on Monday.
Yeah.
All right, take it easy, everyone.
Best of luck.
Take care. Happy 4th of July and Freedom Day.